Hello, everyone, and welcome to the Upside Ticker Talk, episode 6. Very excited to be back for another episode today. It is November 12th. It's already snowing here in Toronto and Montreal. Just happy to be here in the studio with a great guest today. So we're going to get to introducing our guest joining us today in just a minute. But as always, we do recap our last episode, which you can catch on your favorite podcast app, as well as on YouTube. We had the chance of hosting Cameron Chamberlain, who is Director of Portfolio Strategy and Portfolio Solutions here at Fidelity Investments Canada. So we had a great conversation about portfolio construction with the help of ETFs, some of the things that he looks out for when building a model portfolio, some of the risks potentially to consider, as well as things that he's been discussing with advisors and investors that are top of mind this year. So feel free to check that out. Obviously, love the support. So thank you very much. Quick note, I guess some housekeeping. We usually start with a market recap, but just given the nature of how we record these and when we release them, we're going to forego doing market recaps going forward. We're going to touch on the Canadian ETF industry, which we kind of look at the last month. But for any more timely kind of market-related, recaps, topics, analysis, there's too much time difference. Things move too fast. Obviously, as many of you know, markets move extremely quick, especially in a year like this year where it feels like so much has been going on. So quick note there. Mark Verrilli is joining us today, ETF strategist here at Fidelity Investments Canada. Mark's a CFA charter holder. You've been at Fidelity for more than 6 years now, 7 years?
Coming up on 8 years this year.
Coming up on 8 years. All right. Yeah, so almost the same time as me. And yeah, we're super happy to have you, man. This is going to be awesome. We're going to talk about all things Canadian ETF industry. We're going to try to recap some of this year. Obviously, we're getting close to the end of the year. This is our second to last episode between now and kind of wrapping up the calendar year. But then we're going to try to, maybe look forward a little bit, what's going to happen in 2026. So thanks for joining us again, man.
Yeah, thanks for having me. Been a crazy year for the ETF industry, right? Like records being broken all the time. So it should be a good conversation.
I think the title for our show is going to be the records year that was. So I think that's very fitting. So actually, let's get into some of those trends. That's like, once again, usually we start with the market. Skipping that, let's go straight to the industry. And we're recapping October right now, which was a phenomenal month. We're talking about $9.5 billion in inflows. That's bringing the year-to-date total to around $95 billion. Actually, as of November 12th, which we're recording on today, we've actually crossed $100 billion in net new assets coming in to the Canadian ETF industry. Some of the key points that I've highlighted for October, some of them are trends that actually started since the beginning of the year that we've just seen continue. Some are actually relatively newer. One thing that stands out, I think, is equities continue to lead the way with $5.5 billion going into equities for the month. One thing that has changed is pretty much an even split between Canadian equities, U.S. equities, and international equities, which was, I'd say, for the majority of the year, really kind of favoring the international side. So we're seeing a bit of a comeback for demand in North American equity mandates. Another point I thought I'd mention, multi-asset ETFs. The consistency we're seeing in terms of inflows there has been phenomenal. Obviously, that's really an area where we've carved out a niche, I feel like, at Fidelity. We're talking about another $1.4 billion over the last month. The all-in-one ETFs that we manage here are continuously kind of some of the best-selling products in that category. So once again, thank you for that. On the fixed income side, similarly to equities, where it seems like there's been really a risk-on appetite, we're seeing outflows to cash and very short-term bonds, as well as a shift from government towards corporate bonds. So really kind of some risk-taking going on there as well. So a little bit of duration being added. So that's something that I think is very different than the environment that we had seen like 22, 23. HISAs were very popular, very short-term bond mandates. That's seemingly changing a little bit. And the last point I had was positive inflows into commodity ETFs, gold and silver continuing to lead the way. Obviously, the price appreciation we've seen in those two commodities has been phenomenal this year, especially with gold really being one of kind of the main headliners, it feels like, in most market recaps of the year. But maybe we're seeing it slow down a little bit. And obviously, prices pulled back a little bit, so is flows, but they're still remaining positive into October. With all that said, Mark, I'll give you a chance to kind of add some meat around the bone. Thanks, there. Man. I mentioned a few things, but what's caught your eye, and like what are some of the things that you found most interesting?
Yeah, a lot of information there. But what I would say is that this year is no exception from other years, where it seems like we tend to have flows chasing performance. In a lot of different areas. That's pretty common in the industry. It's probably counterintuitive, unless you're chasing momentum, which has continued to work well, but pretty common, right? Like international equities did really well in Q1, big reversal in pessimism that we saw in Europe. and we saw a lot of flows. Post taco trade with Trump and taking the tariffs off the board and U.S. markets take off, like U.S. equity flows have ticked up. It's interesting in fixed income. Maybe it's a bit of a different story. You talked about corporate bonds getting more attention.
Mm-hmm.
I find that interesting because you're not getting paid a lot to take on more risk for corporate bonds versus treasuries, right?
No.
The term we use is spread.
Mm-hmm.
And spreads are as tight as they've ever been.
Mm-hmm.
So I find it a little bit interesting. Maybe that's people looking at, oh, this asset class has done really well the past few years. Like, let's try and get this into the portfolio. And of course, interest rates coming down a lot, especially in Canada. But even in the US, like, although the Fed hasn't cut as much as maybe we had expected them to at this point, like treasury rates have fallen the past few months.
Yeah.
Right. So it makes sense that people are getting out of short-term interest rate holdings, but to see people jumping into corporates when there's not a lot of premium for the risk you're taking, I find that a bit interesting.
It's a good point because usually you see like a massive uptick in demand when spreads have widened and you're starting to see opportunities, right? Think of years like 2020, for example, like a lot of demand for corporates, high yield, some of those kind of spread sectors, if you will, in the fixed income side. I think it's just has to do a lot with the sentiment of investors, which feels like risk on all around is kind of playing out. And I guess maybe your thoughts on that topic more from an equity lens. It seems like also whether you look at various indices or you look at sectors and you look at even factors, like the things that are popular is the things that are more volatile right now. Like I don't think many people are shifting to defense quite yet, albeit I think a lot of people are starting to think we might need to add some defense at some point. It hasn't shown up in the flows really.
Yeah, well, when we talk about the market, we always think about the U.S. market, and the story this year with the U.S. market has been AI, right? And people have been extremely risk on with that trade. And it seems like if you're attached to that theme in any way, you've performed really well, whether or not you've got strong fundamentals or poor balance sheet. And if you're spending money on AI, people seem to be rewarding you for it. We'll see if that trend continues on into next year, but it's certainly been capturing investors' attention. But in other markets, like you mentioned, Canadian equities, international equities, those have become a lot more popular this year as well. They've performed well for very different reasons, right? Like in Canada, it's been a story about gold and the rally with gold, with everything going on between Powell and Trump. Like, are people getting away from the U.S. dollar a little bit? Is gold becoming a safe haven asset again and taking some steam away from the U.S. dollar? Maybe. Yeah. And then with international equities, it's been financials that have done really well out there, like completely different from what we've seen do well in the U.S. So that's certainly the story in the U.S., but I think in other markets we're seeing different things work well.
Yeah, no, it's great points, and I think you're like with the U.S. What's really interesting is that now you're getting the kind of the ripple effects of those mega cap growers spending, using a lot of their free cash flow, which most of it is, I mean, not many of them are using financing to spend on this AI kind of investment cycle, which is probably a good thing, a positive in the sense that like, it's not like the tech bubble where it was like these companies were leveraging themselves to try to get ahead. It seems to now it's like, at least this is being organically financed for the most part. That's not the case maybe for the companies lower in the market cap level, right? Because there's a lot of, whether it's on the crypto side or quantum computing, like all these other kind of subsectors derived from this, I guess, AI/investment boom. A lot of those names have moved up really fast, but a lot of them also don't find themselves maybe in some of the more popular, larger index type products. Yeah. But if you look down in the cap spectrum, you're seeing some kind of crazy stuff. And that's really the what it comes down to, I think, is when you look at the fundamentals of a lot of those businesses, like they don't particularly screen well for most. Like anyways, from our perspective, when we're looking through a factor lens, like let's say you're using quality, value, low vol, momentum, like other than momentum, and even then, like risk-adjusted momentum's maybe not scoring very well, but just absolute returns, yes. The three other metrics aren't really giving you a clear cut, like this is a buy, right? It's kind of a very typical, I think, kind of early cycle recovery where it's not early cycle from a macro standpoint, but just kind of like a slightly euphoric type market where everything that's derived is just working. Kind of reminds me of Q1 of 2021, right? Where you saw like a lot of names just kind of the meme stock rally type thing. Not saying that this is the same thing with regards to the theme of like AMC and those types of names, but it's indiscriminate of the quality of earnings. It's indiscriminate of the volatility profile of the stock, indiscriminate of the valuations.
Yeah, a couple of things that I'm kind of paying attention to on this theme. CapEx is going up a lot. And a lot of these companies have a lot of cash to pay for, the infrastructure they're trying to put in place to build out their AI. But is it sustainable, right? Like the spending of CapEx relative to free cash flow for a lot of companies it's a much higher percentage than it used to be. It used to be like 30 to 40%. Now for a lot of companies, even in the Meg 7, it's like 60 to 70%. So is that sustainable in the long term? I guess we'll find out. And then we have seen some companies start to issue bonds, right? And they haven't done that in a long time.
True.
So investment grade spreads have ticked up ever so slightly to just say, the market's kind of paying attention to this. It doesn't seem like it's a problem yet. And, the fundamentals and balance sheets are so strong for these companies and been successful for the better part of 15 years. But it's worth watching.
But there's gonna, and I think the message that we can to be shared, I guess, to the audience is that there's gonna be winners and losers, right? So like also diversification, classic, and it's kind of boring to repeat that, but like globally diversified portfolio this year, like you said, there's a bunch of different things that are working as well, whether it's materials in Canada, whether it's financials in Europe. Having a diversified portfolio maybe allows you to avoid or to at least minimize some of the impact if there is some type of rotation out of those names. So something to keep an eye on. And that was great. I think just in the interest of time, we probably kept on rambling about various topics there. So we gotta keep ourselves accountable. But the second segment of the show, which is always one of the favorites, is answering the internet. So Mark, let's take a crack at answering some questions from our internet audience. We sourced this from Reddit, and please keep them coming. I think we had like 30 something to pick out of this month. Obviously, just due to time constraints, we only have about 4 or 5 that we can answer. So I jotted some down here, and we'll kind of take turns going back and forth answering these, and we'll all kind of go back and forth ourselves. But I'll throw the first one to you. And the first question is, how should an investor approach rebalancing when most of their investments are ETFs? Should you rebalance at fixed intervals or react to market moves? And I guess for most of these, there's no right or wrong answer. But
yeah, I completely agree. There's no right or wrong answer. The expression we use a lot in finance is it's hard to catch a falling knife. I think simplicity is king when it comes to this kind of thing.
Yeah.
For me personally, like once a year is when I'm reviewing my rebalancing. Rebalancing is a natural way to buy low and sell high. So if you can do it a bit more frequently, like probably not going to hurt you, probably not going to help you, but like 1 year intervals, it's just an easy way to review it. And you have to think about the trade-off between the amount of time you're spending on doing these sort of things.
For sure.
The costs, or, is there an actual cost in your account to transacting? If you use a financial advisor, does your financial advisor charge for these types of services? It's good to know these things and kind of weigh the pros and cons, but I think once a year is a good routine to get into for rebalancing your portfolio.
For sure. And I think even if we look at like, say, our all-in-one and ETF portfolios as just kind of like a benchmark, if we'll to look at, we do have a fixed 1 year rebalance where we bring everything back to neutral. And it's kind of an opportunity to relook at, positions like, should I keep owning this? Should I maybe remove this? Should I bring this back to kind of the way that I intended it to be, or maybe trim something? I guess to kind of just wrap that up and build off of it, I think the number one thing too is like, it's time in the market, not timing the market, right? So it's like if you're trying to kind of sell because you think it's the top, that's almost hard. That's almost more big of a detractor than the opposite, which is like buying when you think it's at the bottom, like timing the bottom. So my big thing is just buy consistently. If the markets are up a lot, maybe you buy a bit less. If markets are going down, you buy a bit more. Let's just keep it very simple in that sense. But I think the whole dollar cost averaging, just every paycheck just throwing in a little bit, it kind of naturally rebalances for you also to a certain extent. But I agree with you. Just at least like once a year to take a look, like, is this still how I want to be positioned? No good. Second question. If I already have a portfolio of broad market ETFs, is there value in adding alternatives exposure? Maybe we should also have had Brendan, our colleague Brendan, on to come and answer this one, but we can take a crack at it.
Sure
and adding alternatives exposures like bonds, real assets, covered call ETFs, or does that just complicate things for no large return benefit?
It does complicate things for sure.
Fair.
I think the data will tell you that it might not necessarily get you ahead for your total absolute return, but your risk-adjusted return, it can certainly help in that area. And by that, I mean, alternatives tend to have low correlation to traditional asset classes.
Yeah.
And Finance 101 will tell you low correlation means we're going to smooth out our return profile.
Yeah, smooth out the ride.
Alternatives can have a place in a portfolio, especially considering over the last 5 years, correlation between equities and fixed income has gone up. and people are looking more and more at their 60-40 portfolio and thinking about it as a 60-20-20 or a 60-30-10, whatever it may be, but allocating a bit of it towards alternatives. The challenge is, you have to think about liquidity of those assets. Like if you're thinking about real assets, like if you're buying properties or real estate, like you can't sell it if you need the money, right? You can, but it might take some time. You might lose money on it. It might not match your investment goals. Liquid alternatives, on the other hand, like those can be maybe a better opportunity to introduce them into a portfolio for those correlation benefits. But if you're just thinking about absolute returns in the long runs, I'm not so certain that it's going to make a huge difference.
True. No, absolutely. And I think you're right. And I think it's kind of like, what's your objective? Like, what's your investment objective? What's your outcome that you're trying to look for? Like, I think a lot of these types of strategies, like even covered calls that were mentioned here, if you're looking to generate income for X, Y, and Z reason, like, that could be a way to increase your income generation a little bit. Or like you mentioned, like liquid alternatives that are more kind of the, whether it's infrastructure, right, public real estate, private real estate, all those different things. Yeah, it can offset some of the risks of equity markets, but is that what you're intending to do, right? Like if you're in for the long haul and you're investing for more than 15 years, like is it materially going to impact the outcome? I don't know. So it really depends, I think, kind of like what your investment objective is as well.
It's a great point about option strategies are becoming so popular. Like how many ETFs did we see launched this year that have embedded options?
More than we can count.
Yeah, it's important to recognize how are these going to impact my return profile. There's no free lunch, right? Like if you have an ETF that uses options to get you a lot more yield, you're probably giving up something somewhere else. So it can turn your return profile into something that looks a little bit different. And if that makes sense for you because you need more cash flow, great. But if you're looking for long-term returns, like it might not necessarily make a better fit than just traditional equities.
For sure. All right, that was a good answer. Let's get to our third question. What time is it right now? Okay, we got time for a couple more questions. How do I know when the ETF I'm buying has meaningful different underlying exposure versus just a different name for what's basically the same thing? Okay,
can you expand on that a little bit?
I think I need to reread that one again. I'll take a crack at it. How about that? How do I know when the ETF I'm buying has meaningful different underlying exposure versus just a different name for what's basically the same thing? Okay, so basically the way that I'm understanding this, and I'm sorry for the person that asked this if I'm reading it wrong. It's a little tricky wording there. Maybe it's my French. No, it's not, because you're right. So one of the key things I think to look for is like if you're trying to differentiate between a couple of ETFs that have either similar name or have their stated similar objective, like the best way to compare them, obviously, and this is, it does require some research, but you can look up a fun fact page, for example, like on for every ETF, that trades in Canada, the asset manager or the issuer has fact sheets that allows you to see the geographic mix, the sector mix, the top 10 holdings. It allows you to see, the number of holdings. Like those are all ways that you can start to piece together. If, because for an example I can give, which I think I've seen many times in the past, is looking at two dividend ETFs that have very, very different strategies. But the name would suggest that they have the same objective, but the actual underlying process and underlying holdings are completely different. So I think just starting with that, like the number of holdings, the type, like the sectors, so like the types of holdings, you can clearly see if they're more defensively tilted, if one's maybe more axed on yield, maybe one's more tilted towards like dividend growth. So that's the dividend example, but I think that can apply for even like any other type of strategy that's defined in the name. But I will give you the benefit of the doubt to the person that's asked this question. It is confusing. And there are so many ETFs now that it feels like there is more room for confusion with certain types of these products. I don't know if you've come across that type of situation before, but I feel like it's happened to me a multitude of times. So
yeah, the dividend example was the one I thought of right away.
Okay. So I'm not the only one to get trapped.
No, I completely agree. Like if you're thinking about dividend growers versus total income, it's completely different companies that you're going to have, right? Dividend growers is going to feel a lot more like a growth ETF. Versus income companies is going to feel a lot more like value leaning. Right. When it comes to passive investment vehicles and comparing those from different companies, the differences are going to be a lot more marginal, right? There, it doesn't make as much of a difference between who you use. Things like tracking error and the management fee are probably important considerations to look at. But when we're thinking about value ETF A versus value ETF B, they can be a lot different.
Absolutely.
That's such a generic term, and every company is going to define it differently. And, if you can try to understand the methodology, if it's available, that's obviously going to be your best way into figuring out what's under the hood. But like you said, looking at things like sectors and top 10s can really tell you a lot, because top 10s often are a huge portion of an ETF.
Usually at least, I should not even make that broad statement because it can vary so much.
It can vary, and I think like an equal weight, then the top 10 is less relevant. But for a lot of ETFs out there, the top 10 really gives you a good look into what to expect for the product.
For sure. No, good points. All right, let's take one last one, and then we're going to move on to the part where I get to pepper Mark with questions.
Perfect.
How much do fees matter in ETFs, especially when performance is similar? Why choose one over another based on cost? You want to take a crack at it first? Or you want me to?
Yeah, I can take a crack at that.
Go.
Yeah. So, we work at a company that runs a lot of actively managed, quantitatively managed products. So our fees tend to be a little bit higher for those products.
Yep.
Our emphasis is on total return and trying to create a better investor.
Total return net of fees.
Total return net of fees, and trying to create maybe a differentiated investor experience.
Yep.
Maybe that means lower volatility or better risk-adjusted returns, whatever it may be. I think it is important to look at net of fee returns, but also when you're looking at net of fee returns, looking at the consistency of the track record for that manager. Did they have one outstanding year?
Yeah.
And that's been a huge driver of their alpha. If that's the case, maybe that's a red flag and something worth taking into consideration. If it's a manager that's consistently outperformed their benchmark in many different market cycles, when different things have kind of led the hit rate, the batting average, whatever metric you might want to use for that, that's an important consideration to look at for active management. When we're talking about passive investments, then cost is probably a huge consideration.
Absolutely. No, I'll echo exactly what Mark was mentioning with regards to total return net of fees. And actually, when you look at, the performance of a product, let's say, whether it's on any financial database, for the most part, you are looking at net of fees performance. And often, so we've had the opportunity to do events across the country, and even they have we met, obviously we spend most of our time with advisors, 98% of our time, but we have done a few these kind of investor focused events, and a lot of investors come to see us and they're like, oh, well, that's your return, but what about after fees? I'm like, no, this is the return after fees.
Yeah.
Right. So if you see a product that's at let's call it 1% fees, and you compare it to a passive product that's at 9 basis points of fees, the performance that you're comparing when you look on the database that you look at, or whether it's on your trading platform, or it's Morningstar, whatever place, it will be after those fees. So I think the net return really is the one thing that you want to look at, and then the other level you can even get to at that point is even tax efficiency, but that's net of tax returns. So that's maybe a bit more complicated, but that's also something to consider as well. And then just to echo your point with regards to passive is right. So if you're buying if you're hesitating between two S&P 500 ETFs, you want the one with the lowest cost, because the tracking error is going to be so small on both products. The only thing that's important at that point, I think, is just liquidity and price, right? So I think it's something to consider when you're looking at those strategies. Good points. Final segment, Mark.
Let's do it.
Little guest interview. Let's start with, I did this with Sebastian. Sebastian was our first guest on the podcast, and Sebastian's also an ETF strategist with us. He's on the East Coast, Eastern Canada, so I get to see Seb a bit more. So happy that we're doing this together. And maybe some people that are listening in right now haven't had the chance to hear what an ETF strategist does.
Sure.
What does your day-to-day look like? So
I
think that's where we can start. Maybe the audience gets kind of a picture, an idea of the work that you guys are doing. And
sure thing.
If you could walk us through kind of day-to-day and what the role entails, that'd be great, I think.
Yeah, in corporate buzzwords, I like to say we're the connection between internal stakeholders and external stakeholders. But
fancy.
In layman's terms, it really means, as an ETF strategist, we're meant to be experts on the products that we offer within the ETF landscape.
Yep.
That means that we're constantly meeting with the various groups and portfolio managers that run these products. I mentioned earlier, a lot of them are factor-based or quantitative-based. So that means meeting with our quantitative index teams that are based out of Boston, taking their messaging and trying to translate it into something that we can use for our client audience, which for the most part is financial advisors. Yep. Sometimes we do a bit of direct client-facing activity like this today. Sometimes we meet with dealers directly, like we'll meet with the banks when they're trying to decide product recommendations for their advisors.
Yeah.
Sometimes we'll work with our institutional group.
Yeah.
But for the most part, it's how do we link the messaging from our portfolio managers to our advisor client base? What are the problems that our advisor client base is facing when we're discussing what they're doing in their portfolios on a day-to-day basis?
Yeah.
And what strategies can we use to try and, mitigate some of those issues?
You put it very well. I think it's almost like somewhat of a consulting job in the sense, or like obviously being subject matter experts in our lineup, but it's really about helping advisors find solutions for problems that they might see or looking to solve in their portfolios. And obviously we're doing that in partnership with our sales teams, but that's, I think, the real interesting part of the strategist job, right? Is that you're the link between all these different parts of the firm to make sure that we're sharing as much insights as possible. So thank you for that. What made you decide that you wanted to do this? Because, I mean, we both started on our sales team, and obviously I came over back in 2018. You joined us a bit after that, but like, what made you decide that, the ETF space was it for you? It was something that was, I guess, exciting.
Yeah, well, it's certainly where the puck is going, to use a hockey term, right? Like, it's the growth part of the business. It's where we're seeing a lot of flows, both in the industry and even at Fidelity. Like our customer base, the products they're using has really changed, and ETFs are becoming a much bigger part of the picture for us, which certainly wasn't the case when I started at the company, 7.5 years ago. So it's exciting to be in the growth part of the business. And at the same time, moving from a role that was completely client-facing to a role that incorporates both client-facing and product knowledge was exciting for me. Like, I'm a pretty social guy. I really enjoy the client-facing aspect of the business. But, I also did the CFA coming out of school. So I've always wanted to get into a role that lets me kind of use that knowledge a little bit more. And a lot of what we do tends to get a little bit more into technicals with advisors. So I enjoy having those conversations too.
And here I thought it's because you wanted to come work with me. That hurts. No, that's awesome. And you're right. It's like it's really a good hybrid. Like I'm kind of the same. Where it's like I didn't do my CFA, so hand up. That's why maybe I always make jokes about it, because I'm kind of jealous. But I did do my master's, and it was the same thing. It's like I'd like to apply that knowledge that we've acquired, but I still do like to talk a lot, right? And maybe that's why
there's something about spending so much time studying. We're like, I gotta use this at some point, right? So
I couldn't have wasted all these hours for nothing. No, you're absolutely right. I think that's what makes it really stimulating. Every day is different as well, right? So that's the fun part. But you mentioned that you're working with, like a lot of the time spent working with advisors and meeting with them and understanding their business, like how we can incorporate ETFs in their practice, and like what's the number one kind of, I wrote down in my notes here for the question, going concern. I don't know if that's the right way to say it, but like, what's the thing that they're asking you guys about, thinking like, hey, I'm kind of thinking about this, I'm worried about this, or maybe, like what's the number one thing that's being talked about in those meetings right now? Give a lens into that.
For sure. This probably won't come as a surprise, but AI, right? Valuations are getting really stretched for a lot of these companies. The word bubble is getting thrown around here and there. So advisors are increasingly paying more attention to what's happening with tech in the US. And can it continue to run at the same momentum that it has this year? I don't think people are screaming and running to the sidelines and scared of the market by any stretch of it, but they're considering, like, should I take some profits off the table? This is a sector that's done so well over the last couple of years, but also since the great financial crisis in general, right? So a lot of people are just considering, our valuations getting a little stretched, and is there other parts of the market that I should be doing benchmark allocations towards? Yeah.
That's a good point. No, I think you're right, and it's to your point. It's not the biggest surprise, but I think it's completely understandable that that's the thing that comes up the most, because one, we hear about it every day. Right. Whether we like it or not, it feels like we're hearing about this. Exactly. There are a lot of alternative options out there. It's just about, I feel like nobody's ready to capitulate and kind of, make that defensive move to prepare, because, it's worked and it's been working like since 2022. Like if you've been overweight, kind of a lot of those whether it's tech sector, comm services, some of the consumer discretionary space in like the US especially, it's been really rewarding. So fully understand that that's top of mind. Kind of on the flip side of that, like what's the number one kind of opportunity or theme that in your meetings is coming up as like this is something we're excited about, like something that we could see as a development or an opportunity? Not to say like, not to make a call, that's not really what I'm saying, but it's like stuff that's like, oh, that I could consider this maybe.
On a similar note, I think it's international equities, and that a lot of people have left them for dead, for lack of a better word, because the U.S. market has done so well. But because international equities have outperformed the U.S. this year, a lot of people are starting to pay attention again, and fundamentals are improving. We talked about like a big reversal in pessimism, whether that was, geopolitical or tariff related, whatever it may be. But there's a lot more excitement in international equities for those companies to perform well. And I think that it's becoming a bigger conversation every single day that I'm having with advisors is how can we get access to these markets in a meaningful way? And, we talked a lot to our portfolio management teams, and a lot of them won't tell you like we're selling US to buy international. We're underweight one and overweight the other. But they are saying, like this deserves a benchmark allocation in an investor's portfolio because we've just paid so much attention to the US for so long.
Yeah. No, that's a good point. And I'd fully echo that. I think it's also just a function of kind of the opposite, which is like, should I be trimming my US because it's done so well? It's kind of the opposite of international. It's like, this has lagged for so long. It's like, maybe I should increase it back to like my neutral weight in my portfolio, right? Or what I envisioned it should be like, that's 5%, 10%, 15, 25, whatever it may be. It's like, maybe it's probably down from what the target was initially, if you will.
And there's things to get excited about in Europe that happened this year, right? Like the amount of bills that have come out probably because of the trade war to encourage European countries to spend more on infrastructure and defense, trying to ease regulation in a lot of areas, taxation as well.
Well, the largest
there's meaningful stimulus going into the economy.
When the largest economy in the Eurozone was under austerity for like 5-6 years in Germany, it's kind of tough to see.
Yeah.
And it's nice to see, obviously, that like that seems like it's changing from a fiscal spending standpoint. You're absolutely right. What time? Oh, we got a few minutes left, so I'll try to keep it short here. Let's take 2 more questions and then we'll wrap things up. But I guess, without making a prediction, like nobody's got a crystal ball. That's not the objective. But, in terms of some of the themes that we've talked about this year from a flows perspective, so like industry, like what people have been buying this year, what do you think continues and what do you think maybe slows down next year in 26?
It's a good question. It's hard to imagine that flows slow in the U.S. market. Performance has been so dominant in the last few months. And we talked about earlier that flows tend to follow performance, and it's not necessarily like the best strategy at all times, but it is something that tends to happen. So it's hard to imagine that U.S. flows don't continue in a strong manner. Like we saw international really come on the scene and Canada really come on the scene this year, but in more recent months, it started to lean back towards the U.S. I could see that continuing to trend.
That was going to be kind of like my follow-up kind of not follow-up, but just more kind of like, let's go one step further. It's like, it's like, it's just probability wise, the chances of seeing more US equity flows than international equity flows next year, I'd say is better than 50-50.
You're probably right. And like strong performance in Canada and international markets has obviously helped that. But I find when I speak to advisors or even sometimes like my buddies about U.S. companies, like they can understand the business, they can see the impact because they use the technology every single day. The same can't necessarily be said for a gold mining company or a bank in Europe. People
your friends are
they just get excited about like the things that these companies are doing, right? So I find like that euphoria kind of drives a little bit of their decision making,
for sure.
Even though that's probably priced in.
Okay. And anything you think is gonna, so that's kind of just more like, so maybe like just a retransitioning big back favoring the U.S. Anything that you see kind of slowing down, whether maybe not even necessarily have to do with equities, but like an area that's like, so I guess I'll just throw an example out there. Like say like levered products this year have been super popular. Like you see that continuing just because, I mean, so long as risk appetite is there, I feel like that's
exactly
might stay. But if we see a bit of a crack, I don't know. Like is there something you see slowing down?
Markets continue to go up. Like I don't see why levered products would slow down, right? Like people are going to want to continue to take on risk. I think something that'll slow down maybe a little bit is single stock ETFs.
Yeah.
Those have become really popular this year. So an ETF that might hold NVIDIA but have embedded options that change the characteristics of the return profile. I think that will slow down because
it was the new shiny toy this year, basically.
It was a new shiny toy, and you can get really attracted to things like yield, but maybe forget about total return. And what's my goal as an investor? Is it to use options to generate a lot of yield, or is it to be in the market for the long run to try and grow my wealth? So, these trends have been really popular, but I think once people live the investor experience over a bit more of a longer market cycle, they'll say, you know what?
Yeah, maybe
do I need this? Yeah. Do I really need this?
No, awesome. All right. So last question, which round of the playoffs are the Leafs losing in this year?
I'm not even sure if we're going to make the playoffs this year.
Oh, goodness.
Yeah, it's always tough when you guys come into town as Montreal Canadiens fans, especially in a year where you're dominating the standings versus the Leafs. But
it feels good.
It doesn't look good for the Leafs right now. The defense is not playing well. We look slow. We're giving up a lot of goals. I don't have a lot of confidence.
Okay, and it's not like you guys unfortunately have the Raptors that can cheer you up. So anyways, let's move on. Let's wrap up. Mark, thank you so much for joining us.
Thanks
this was awesome. This has been really fun, and thank you everybody for listening in. I hope you enjoyed the show. Keep submitting your questions. Feel free to subscribe on our YouTube channel. And yeah, we'll see you next time. Thank you.